Graham's Chapter 13 is essentially a working example of security analysis. Rather than spend more pages on abstract rules, he picks 4 listed companies and walks through the kind of facts and ratios an analyst would use to judge whether the market price makes sense. The 4 firms, Eltra, Emerson Electric, Emery Air Freight, and Emhart, aren't exotic. They're ordinary businesses with ordinary financial statements. That ordinariness is the point. By comparing them side by side, you can see cleanly which business traits the market rewards and why 2 companies that look fairly similar on paper can trade at very different price multiples. What jumps out immediately is this: price/earnings ratios move around a lot more than the underlying business fundamentals. In Graham's 1970 snapshot, Eltra and Emhart were trading at modest multiples, roughly 10 to 12 times average earnings, while Emerson and Emery were priced way higher, in the 30s to 40s. Look under the hood, and the 4 companies don't look that different. They are profitable, reasonably stable, and not badly leveraged. So the premium for Emerson and Emery had less to do with balance sheet safety than with market appetite for recent growth and glamour. Emery, the freight forwarder, had produced very large percentage gains because it started from a very small base. Those percent gains can be intoxicating to the market, but they're also the easiest to slow down once the business becomes big. Graham's comparative review walks through the familiar dimensions every investor should check: profitability and margins. Who earns most on the dollars invested and the dollars sold? Emerson and Emery showed stronger returns here, which helps explain their high multiples. Stability. How bad was the worst down year? A company that avoids big swings is worth more to a conservative investor. Growth. How fast and how reliably have earnings grown? Rapid growth can justify a premium, but growth that came from tiny numbers is less durable. Financial position and dilution. Current ratios, long-term debt, and convertibles matter. Emerson had convertible preferreds. When you treat them as converted, EPS falls a bit. Dividend history. An uninterrupted dividend record, Emhart's goes back decades, is a strong quality signal for defensive investors. Price history and momentum. Past price runs tell you what investors already expect. Momentum can sustain high valuations, but it doesn't remove risk. After weighing these factors, Graham argues what you might expect. A conservative investor should prefer Eltra and Emhart, the cheaper, more value-oriented names, because they meet plain quantifiable tests: size, strong finances, long dividend continuity, no large earnings deficits, reasonable price to assets, and price to earnings. Emerson and Emery are not fraudulent or worthless. They're simply expensive bets on continued outperformance. For a buy-and-hold investor who wants safety and a margin of error, the low-multiple pair looks preferable. For someone willing to research deeper and tolerate higher volatility, the high-multiple pair could make sense, but only if the future justifies the price paid today. The chapter's later commentary brings the same method into a modern setting by redoing the exercise with 4 later E companies: Emerson, still the industrial, EMC, a tech storage superstar of the 90s, Expeditors, a logistics operator, and Exodus, a dot-com host. The outcomes are a neat reinforcement of Graham's original lesson. Emerson the industrial remained a steady company. Expeditors turned out to be a high-quality growth business that lived up to expectations. EMC's astonishing rise proved unsustainably high when growth and margins slowed, and its share price collapsed later. Exodus, the dot-com idol, glittered briefly, then disappeared into bankruptcy, a classic example of hype without durable profits. The modern cases underline the same 2 truths Graham emphasizes: market prices are forward-looking promises, and you pay today for future results. If the promised results don't appear, the price adjusts, often painfully. Momentum and excitement can keep a stock expensive for a long time, but they don't make the underlying business safer. Practical checklist. Quick and useful when you compare companies. Don't buy only because recent growth looks spectacular. Check whether that growth comes from a tiny base. Compare current P/E ratio to realistic sustainable growth. If you're paying a very high multiple, you need a very reliable growth story. Look for stability, uninterrupted dividends, limited worst-year declines, steady cash flow. Inspect the balance sheet, low leverage, healthy current ratio, and watch for dilution from convertibles or large option overhangs. Distinguish momentum from intrinsic value. Momentum can persist, but buy it only if you accept the risk. Match the stock to your temperament. Value-oriented investors prioritize margin of safety. Growth investors must accept greater volatility and do more homework. In short, Chapter 13 isn't just about 4 companies. It's a small workshop in applying the same basic checks to any stock. Compare profitability, stability, growth, balance sheet quality, and payout record. Then ask whether the market price is asking too much for the future. If you stick to those facts and resist the siren song of hot momentum, you stack the odds in your favor.